Hey there traders, ever been caught in a sudden market move that seems designed to mess with your positions? Today, I'm breaking down two sneaky market moves, the stop block and the FU candle. First up, the stop block. Imagine this, you set your stop loss at a logical support level, only to see the price dip, trigger your stop, and then reverse sharply. That's a stop block for you, a false breakout designed to sweep liquidity and trap traders. You'll often spot these at major support or resistance zones, followed by a sharp move in the opposite direction. Now let's talk about the FU candle. The name says it all. These are large, aggressive candles that seem to scream, "Screw you" to traders. They push the price beyond significant levels, triggering stop losses and invalidating your analysis, only to reverse in the intended direction later. You'll see these more in low liquidity environments or before big news events. Why do these happen? Market manipulation. Big players, banks, hedge funds, hunt for liquidity by targeting areas heavy with stop-loss orders. They exploit retail traders who set stops in predictable spots like just above or below recent highs and lows. So how do you outsmart them? First, understand liquidity zones. Identify where stop losses might be clustered and look for wicks and volume spikes as signs of stop hunting. Next, avoid predictable stops. Use the average true range, ATR, or volatility-based measures to place stops in less obvious locations. Always wait for confirmation after a stop block or an FU candle. Look for signs of the actual trend before jumping in, and remember, risk management is key. Ensure your trades have the right risk-reward ratios. Lastly, watch for reversals. FU candles often precede strong moves in the opposite direction. Keep an eye out for those signs of reversal after the liquidity sweep. Want to dive deeper into these strategies? Hit that subscribe button and let me know in the comments. Thanks for watching and happy trading.